Good afternoon. I hope everyone's doing well. I think we're all aware of how low interest rates actually are, and it impacts each of us perhaps a little bit differently. It's awesome right now if you are borrowing money or if you're restructuring some debt right now. We had a member of our firm who bought a home recently and was able to get a 30-year mortgage at 2.75%, just a little different than the 10.9% fixed rate I got in 1986 and thought I was doing great. So great if you're borrowing money. It's not great, obviously, if you're a CD investor or a bond investor and the income that you're getting from your safe money is incredibly low. And I saw this the other day, really a great report from JP Morgan, or a great graph, I should say, that talked about not only how low interest rates are and the income that you're getting from investments, but also talked to a great degree regarding how the inflation of other day-to-day things, you're not even able to come close to cover the income with safe money to cover that. And so if you can look at this for a second, this goes back to 1994. And the gray bars show you the income that you could receive in 1 year from a 1-year CD that year, according to Bankrate.com. So again, in 1994, the income that you could get on a $100,000 CD was roughly $3,800. The blue bar is actually the income needed to beat inflation. And so the great thing from this, of course, is in 1994 and 1995 and several years here in the 90s and early 2000s, the income that you needed to beat inflation was you could clearly get in a CD or a bond. Notice a little bit of a hiccup in the early 2000s in terms of how low interest rates were. And then we had an increase in interest rates through 2005 to about 2008. But boy, what's really tough to see right here is, and again, that focus on that blue bar, the income needs to beat inflation. We have not been able to get income from a CD or a bond, a 1-year CD or bond, really for the last decade that could keep track with inflation. And then if you can also focus on the green diamond here, that's the income needed to beat in education inflation. So we need $2,000 from our $100,000 investment, $2,000 in interest to beat that. We can't do that. Interest right now on a savings vehicle is 0.28% in a money market fund. So the interest income obviously would be $280 in 1 year. Look at this. The income needed to beat medical care inflation is almost $5,000 or 5%. So it is really, really tough to see on a day-to-day basis that the income we need to get to exceed these kinds of expenses we can't get from our safe money right now. So this is a cool graph. If you'd like to get this from me, please let me know. But there's also a really good report that we've got from Bankrate.com that talks about different other vehicles that we are using to get a little bit higher income from investments than just bonds and CDs. So this is a free report, Bankrate.com, and or the JP Morgan chart here, ray.evans@PegasusKC.com. Just let me know if you'd like that. One other thing that is a quick reminder, a little bit off topic here, but you may recall that required minimum distributions from IRAs are not having to be taken this year. But if you have already taken it and you'd like to give it back to your IRA and not be taxed on it, the deadline's coming up. It's August 31st. So just make sure that you get that covered. Thank you very much. Again, I hope everybody is staying safe and hanging in there and enjoying as best they can this summer. We'll look forward to talking to you soon. Thank you.